Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, thanks for having me. It's great to talk with you.
Well, after so much anticipation, we knew what was going to happen, and yet we had to see it. Janet Yellen announcing a 0.25 increase in the official interest rate. How much influence does that have on the real world?
Well, none yet, but at some point, higher rates will impact the financial markets in a negative way. If we can think back to the history of Federal Reserve tightening cycles in our lifetime, they have a consistency to them in which the stock market goes up quite a lot, and then the Fed starts to think, well, we don't want to have another stock market bubble come because they can be so devastating when they blow up. And, of course, by then it's already a bubble. They should have raised rates long ago, and that's what's happened again. But then they raise the rates slowly, and nothing bad happens. And then eventually they raise them enough that there is a stock market, bear market that starts, the economy slows down, and then they go into a panic to reverse the situation. So if you think back to the Internet bubble, they were raising rates into the March of 2000 top. The economy hit a brick wall that August. But then in December, the Fed panicked because the stock market fell faster than they wanted to. They reversed course. The same story repeated in 2007. And I'm asserting it's going to repeat again, that same story with the same ending. Today, though, the Dow so far has responded positively to that news. There's a sign that we're in a bear market yet, but it's a dangerous situation. Now, that's kind of like one of the few voices you're going to hear saying that right now, because just about everyone is bullish on the stock market because it's been going up for so long, and now going up without any significant pullback for months on end, and it's hard to even remember when the last correction occurred. We haven't even seen the S&P 500 fall more than 1% now in more than 105 days in a row, which is a record. And other records have been made too. The small investor in 2008 began to get out of the stock market. In 2009 and 2010 and 11 and 12, they actually took more money out of the market than they put into the market. But that started to change, and it really changed after the election of Donald Trump, and the move of the Dow through 20,000 brought a renewed confidence among the small investor and a desire to chase these gains in the belief that they could now last forever, or their risks were gone. And so what we've seen in the past couple months are record inflows from small individual investors into the stock market. There's a story in the Wall Street Journal a week ago that showed that it's the most money put into exchange-traded funds by small investors going back for as long as they can record the data, which is back in the 1990s. At the same time, though, insiders are selling. The insider buying is at the lowest level it's been since around 1989. So that's kind of the story. But at the moment, that doesn't matter. Today, the market's up. But I'm just asserting it's going to get more and more risky, and the actual potential reward to risk there makes no sense to me. I did buy a lot of stuff. I became fully invested the days following the Trump election, but I sold most of the things I bought. And at the moment, I'm just really holding core positions in some gold stocks and gold, because ultimately when we do end up seeing the market decline again in the future, and the Fed panic and stop raising rates and reverse course, it's going to benefit gold the most. And either way, even if you disagree with what I've been saying about the stock market, the fact of the matter is gold put in a major bottom last year after it had been through a brutal bear market in which mining stocks fell 90%. We had a nice rally last year following that bottom, and a correction really from the summer till December. And now it's a sort of sideways consolidation phase, with gold trading in a range really of 1190 to 1250, although I think 1300 is the critical number that needs to be broken before the true excitement will come back in. And I'm not really sure when that's going to happen. We've got to test that 1250 first. But the important point of the matter is that I think this makes a good time for long-term investors to buy gold, buy mining stocks when you're close to $1,200 an ounce. If, somehow there was a decline that got caught up maybe in the stock market falling or whatnot, you're not really risking much from these levels with the mining stocks or with gold itself in particular. So I think that's the thing that's like a safe haven for the future and why people should invest in it to be well diversified. But it's also a good way to make money, period. Instead of chasing something that's been in a bull market for 9 years without any pullback at all, you can buy gold, you can buy mining stocks, which are just 1 year into a new bull market and are kind of closer to support, with gold not that far from the $1,200 mark right now.
We'll have more with Mike Swanson right after the break.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Mike Swanson. Mike, oil, after trading, in the $50 plus range for the longest time, finally has dipped below $50. How long is that going to last?
Yeah, I think that's a very significant break. Oil was in a 2-point range since the start of the year and broke below it. And two significant things have happened along with that price break. First of all, about 3 weeks ago, before the breakdown happened, in the oil futures market, a record oil short position was built up by the commercials. These are the large producers and hedgers, and they even include operators to Saudi Arabia. Well, they had last built a record short position way back in 2014, before oil made its last major top, and which led to the giant decline, which smashed the oil industry throughout the United States and put many fracking companies out of operation. So we, of course, had a bottom in January, February 2016, a rally back up to 50, and tests of 55 a couple times, which never led anywhere. But we essentially saw oil prices go sideways for several months, above $50. And then the oil commercial players, they just added to their short position, and they tend to be correct. And they built a record short position, even surpassing the size of 2014. So that's a massive warning sign that there really isn't much upside potential to oil prices. The question, I think, which I'm not sure we know the answer yet, is why is this happening? Why is oil set to decline? On one hand, news just came out yesterday that Saudi Arabia is increasing its production. It's sort of reneging a bit on the deals that were made towards the end of last year. They want to make more money. And sadly, this is the same thing that happened in 2014. They increased their production deliberately to target American fracking companies. That's at least according to the Saudi oil ministry. He made statements to the fact that they wanted to see the American fracking industry shut down so they could maintain their market share. And back then, the news showed, or studies showed, that that was a Saudi operation that could take about 2 years to go and carry out. But, you know, OPEC's a tough cartel. The members often cheat each other. So it appears that is part of the reason why oil is falling. And I wouldn't be surprised if Saudi Arabia didn't once again build a giant oil short position ahead of the news that they're increasing their production. And then just this week, news came out that the Saudis visited with Donald Trump in the White House. There's a photo op that took place, and they praised Trump as being someone they can work with and someone they see as being aligned with Saudi interests, which is quite surprising. You can remember the presidential campaign. Many times he denounced Saudi Arabia. He linked Clinton to Saudi Arabia. He said Saudi Arabia could have been involved in 9/11, and that should be investigated. So something happened in that White House meeting in which he basically bowed down to them, and now we're seeing oil prices drop. No complaint about Trump about what that could do to fracking companies or anything. Now, there's the other possibility, too, that oil is dropping as a sign of the economy slowing down or approaching the slowdown. And one thing that kind of would suggest that could also be the case is that other commodities have also pulled back. Agriculture commodities, for instance, have all pulled back in the last couple of weeks. And this is all unusual for oil and agriculture commodities to actually pull back this time of year, because they actually historically rally into June and July and then have a short-term peak. So these things aren't behaving as they are supposed to behave, so to speak, and that typically is a sign that there's worth paying attention to and seeing and trying to figure out what it ultimately means. But the simple thing, the obvious thing, is that oil and oil stocks are actually best to stay away from for the time being. In fact, the energy stocks are among the weakest trading sectors of the entire stock market this year. So that's a negative for them. Ultimately, I do think they will be a good buy, but it'll be when these commercials reduce their hedge positions. That's when the bottoms are formed.
We'll have more with Mike Swanson right after this.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're talking with Mike Swanson. Mike, recently gold shares have taken a pounding, especially among the juniors. Is that going to continue?
Well, the juniors are actually very interesting in the action that they're doing, because, of course, they're very speculative companies. They have small market caps for the most part. These are companies, for people who don't know, that tend to be small exploration companies. They buy up properties and drill them to try to find discoveries that they'll then share with larger mining companies, make deals, get bought out, and so forth. Or they're companies that buy existing mines that are dormant and bring them back into production. So these are small cap stocks. In bear markets, they tend to fall more than the big cap stocks due to that fact. In fact, in the last bear market cycle, many of them simply went out of business because if they're not making a profit from gold and only drilling to discover it, then they have to continually raise money by selling shares to finance themselves in the bear markets. That can become very difficult for companies on the margins, and they just go under. Now, what's noteworthy about these stocks, though, and I think tells us a lot about the health of the entire industry, or the bull market, I should say, and it is that last year, the stocks, the juniors, went up substantially with, the GDX, which is the gold stock ETF, that basically doubled. Then they went sideways in the spring, went up a little bit more. But when GDX and the majors such as Newmont and Barrick had their correction peak last summer and declined in December, these juniors pretty much held up. In fact, even recently, over the past 2 weeks, GDX pulled back, and most of the juniors didn't pull back at all. So what I'm trying to hint at is that in bear markets and gold stocks, junior mining stocks get destroyed. And that's not been happening on the pullbacks with gold and gold stocks. And that's a sign that we're not in some bear market in either one. And juniors are good accumulations. Then you buy the right ones that have the best potential, and you can make a nice return. Now, one thing people should know about these stocks, too, is that at the beginning of a bull market in mining stocks, typically the major large cap stocks actually lead and go up more, and then that switches gear, and the juniors then begin to outperform. And we're still in the stage where most of the big caps are going to outperform most of the juniors unless there are, something unique about an individual one or two, like they make a discovery or something. But as a whole, the juniors are lagging the big cap mining stocks. That's going to change at some point in the future. And I think it's going to change when we see gold go above $1,300 an ounce, because that should be the move that finally brings retail interest back into the gold stock market, and they'll start to look for these more speculative opportunities. Right now, as you're speaking, it's really the professional or the most knowledgeable type of investors that are getting involved in the junior mining market. That's one reason why they don't crash when the gold pulls back, because these tend to be strong hands. They're not buying to flip and trade or buying on a whim, but buying because they truly understand how these companies work and the potential in the right stocks. Retail people don't. They tend to be real flippant and kind of like chase fads, but they're important to have to fuel market higher, as you've seen with the Dow this year. But they're going to get involved at some point, and it'll probably be when gold gets above 1,300. And if we get into a situation, which I think is likely, where gold gets above 1,300 and the rest of the stock market in the United States is languishing as that happens, then we're going to see a lot of money chase mining stocks because they could be the only thing that's hot and exciting people's interest at some point in the coming years.
Mike, thank you so much for chatting with us.
Thank you. Great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for our show, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.